Are variable rate mortgages dead? Well, the answer is kind of, at least for now, because less and less people are requesting variable rate mortgages, and that makes a ton of sense, especially given how much interest rates went up in a very short period of time, as well as the fear now associated with those variable rates that have significantly bigger payments or negative amortizations. But that being said, people who have 5-year fixed mortgages aren't necessarily safe either, because at some point their mortgages are going to renew, and they are going to find themselves in a situation where their payments go up. So this is just something that goes along with getting a mortgage in Canada. You're going to have changes in payments over the life of the mortgage. But the question is, how do you choose the right mortgage, and how do you make sure that the mortgage that you choose is the right one for you? And that's what we're going to talk about in this video. But before I get into it, my name's Nolan Matthias, and if you want to thrive financially, this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. And don't forget, you can still get my book, Mortgage Secrets, for free by going to mortgagesecrets.ca. Yeah, that's that little one on the back there in the shelf. You can get that absolutely for free. All you have to do is pay shipping and handling, and it has all the details about how to get the lowest rate. And it has a pretty big chapter on how to choose between a fixed and a variable, which is still completely relevant today. So go check that out. But anyways, let's get into the actual meat of this video, because I want to start first and foremost by talking about a recent article that talks about variable and fixed rate mortgages. And it is, the love affair with variable rate mortgages is over. Now there's a new thing. And the thing they're suggesting is short-term interest rates. So 1 year, 2 year, 3 year rates. And there's no doubt that we are definitely getting a lot of requests now for 2-3 year rates. And the reason for this is, quite frankly, because people believe that interest rates are going to come down in the short term. And as a result, they're choosing shorter term mortgages, thinking that they will be able to time the market and get a lower rate in 2 to 3 years. And I'm going to tell you right now that trying to time the market is a mistake. You might not be making a mistake if you predict it right, but the idea of just timing the market in general is a bad idea. And we've used the same framework for choosing between variable and fixed rate mortgages for at least the 20 years that I've been in the business. And it is really simple. You choose the lowest rate you can get at the time you get the mortgage. If variable rates are cheaper, you choose the variable rate. If fixed rates are cheaper, you choose the fixed rate. Unless, and there's one caveat to this, unless choosing a variable rate mortgage is going to keep you up at night. If a variable rate mortgage is going to keep you up at night, you won't be able to sleep because you're worried about your payments going up or the interest rate going up. Or if your partner, your spouse, isn't going to be able to sleep at night, then you just avoid the stress, because the single biggest stressor in a lot of people's lives is money, and a mortgage is not something that you should choose without keeping that in mind. So the question then becomes, are variable rates dead, and should you be choosing a short-term mortgage? Well, as of filming right now, the cheapest mortgage that you can get in Canada is actually a 5-year fixed. It's priced lower than a 4-year mortgage. It's priced lower than a 3-year mortgage. It's priced lower than a 2-year mortgage and a 1-year mortgage. And it's certainly priced lower than a variable rate mortgage. And this is unique. This happens when we have what's called a yield curve inversion. And a yield curve inversion is basically when short-term rates are higher than long-term rates, because there is the expectation of a recession that is going to happen in the next little while. So using our framework of choosing the lowest rate at the time you can get it and trying to take the guessing game out of it and trying to take timing the market out of the equation, well, the most obvious answer as to which mortgage people should be choosing is the 5-year fixed rate right now, because like I said, it is priced at about 4.5%. That's relative to a 4-year mortgage that's at 4.64%, or a 3, 2, or 1-year mortgage that are all over 5%. And the variables are in the high fives, so they're significantly more expensive than the 5-year fixed. But there's some other things that come along with choosing the right mortgage, because there is a chance that interest rates could go down. And if you choose a 5-year fixed, you want to be positioned in a way so you can get the lower rate if and when rates do drop. And the way to do that is by making sure you're avoiding big penalties. And a little known secret of the mortgage industry, at least if you haven't been watching this channel, is that if you choose a 5-year fixed mortgage at a big bank and interest rates go down, you are going to be exposed to the biggest payout penalties in Canada. Yes, that's right. The most trusted banks in the world, the most trusted banks in Canada, have the biggest penalties when it comes to 5-year fixed mortgages. So in other words, once you choose a 5-year fixed mortgage with them, you're basically giving up all your negotiating power, and you're giving up all of the ability to move to a different lender to get a lower interest rate, because the penalty will be so high that you have to ride it out. Now, on top of that, you also want to avoid the super small discount lenders, Because if you find yourself in a mortgage with one of them, there is a chance that they will have what's called a bona fide sale clause or some other restriction that prevents you from being able to switch to a different lender if rates go down. And you're probably starting to see a theme here. We're talking about switching to a different lender if rates go down. And the reason we're talking about that is because having that ability is what gives you the leverage to get a lower rate when rates go down. So positioning yourself in a 5-year fixed mortgage, usually with a mortgage broker who knows which lenders have the best payout penalty calculations, is going to put you in the best position to get both the lowest rate now and also get the lowest penalty so that you have the flexibility if and when those rates do go down. Now, I talk about this a ton in my book, Mortgage Secrets. You want to make sure you avoid those big bank 5-year fixed and the discount mortgages. And the best way to do that is, like I said, to deal with a trusted mortgage broker, because it is 2023 and most people have figured out that you get a better deal and better advice from somebody who represents you than from a salesperson who works for a bank. Oh, and if you want to know exactly what's going on with rates at any given time, we do a monthly rate update on this channel. So click that subscribe button, turn on the notification bells, and you'll get it. And a link to the most recent one right here.